Well, as Brooke highlighted, the latest consumer price index data shows inflation eased to 3% in June, coming in below estimates. The same can be said when looking at core inflation, as the rise in June also came in lower than expected. Following the latest CPI print, our next guest says inflation at the retailer has come off full boil. Here to discuss this, Bankrate senior economic analyst Mark Hamrick. Mark, is it safe to say we're in the final innings of this tightening cycle?
Of the Federal Reserve, yeah, I think so. We just don't know how long these innings are going to last. There could be a lot of people still coming up to bat. But obviously, with 500 basis points of tightening behind us and the Fed projecting no more than 50 basis points for the most part going forward, we may get 25 of those here at the end of the month. Obviously, that would suggest that we're in the final chapter of this part of the monetary policy story.
Mark, what more do you think the Fed needs to see in order for the Fed to be satisfied, for the Fed maybe to stop after this next rate hike later this month?
It's all about inflation, and really that it's as simple as that. I think that if we were to see further good news, perhaps in the forthcoming prints, not only in the PPI but the personal consumption expenditures, and then we'll get past the end of July FOMC meeting and then go through all that once again. I think also further moderation in hiring, as indicated in the June jobs report. That's the expectation. And you know, I think the problem is that whether you're looking at that core rate, which should not be dismissed, you know, that is the sticky part of all this, right? And so we know that services inflation is probably going to be more persistent as we, you know, go out into the future, and remains to be seen how much consumers give up the ghost, so to speak, with respect to their spending going forward.
So let's talk about the sticky part. I mean, what's it going to take to bring that down? As our guest earlier alluded to, going from 9 to 3%, not easy, but certainly points to progress. That last 1% is really the tricky part.
Mm-hmm. Part of it is demand, right? And so, you know, although it's, you know, sort of economics 101, just think about how much we've really had, you know, this imbalance between supply and demand going back to the very early days of the pandemic, supply chain disruptions, consumers wanting all kinds of things in a big way that maybe they didn't need or want in the past, part of that working and living from home. And now, of course, the demand for services. And part of that, of course, this summer has been demand for travel. And you know, so airlines are sort of basically saying, you know, we'll set our ticket prices where we want to, and hotel operators doing the same. And so it really does take some better balance between supply and demand. And obviously, if we were to see something more serious develop with respect to the economy, we just published our Bankrate quarterly economic survey, and economists still put the risk of recession at basically 50%, or basically the odds being 1 in 2 out over the next 12 months. I would also argue we've seen certain sectors of the economy acting recession-like or recessionary. But as we see that develop, and whether it develops in terms of an actual recession or not, I would expect that we'll see some more flattening in demand in the future, because let's think about the fact that, you know, monetary policy does work with long and variable lags, as the saying goes. And so that means that all those 500 basis points have yet to really be fully felt in the economy. Obviously felt in some areas early on, but not fully felt everywhere.
So, Mark, if there's a 50% chance that you think we're going to see a recession, if the Fed does, in fact, hike 2 more times, what do you think then that the employment picture looks like over the next couple of months? Is it going to be able to stay relatively strong if we do see a more shallow recession?
Well, first of all, you know, I like to think about the fact of the 50-50 piece of that being the glass both full and half empty. And that means that it's not a certainty that we have a recession in the near intermediate term. And that means that there's also a decent chance of a soft landing. But to your question, it's absolutely the expectation here that we do see more moderation in hiring. And think about the fact that in that June jobs report, the private sector accounted for about 150,000 jobs. Government was 60. We won't expect 60,000 jobs from government each and every month. And so at that roughly 200,000 jobs added a month level, that's half the rate that we saw for all of last year on average. And so the previous level was unsustainable, and it's not being sustained. And so I would expect that we'll see some normalization, we may call it, in the job market, because, you know, we just got the beige book today setting up the next FOMC meeting. And you see a lot of references in there to the job market still being tight, some employers still having a hard time finding the workers they want. Many workers are being sort of retained by their employers because they don't want to be in the same spot that the employers were early in the pandemic, where they got rid of them and then all of a sudden had to bring people back, and then asking, of course, where are all the workers?
So, I mean, how do you marry what we're actually seeing in the data versus where the consumer sentiment is? You know, on the one hand, if you look at the progress we've made year on year, it's certainly significant. Prices are coming down, and yet there seems to be this overarching sentiment that things aren't necessarily getting better.
Well, they aren't. I mean, we're still higher over the past year, and we're significantly higher over the past 2 years. And so, yes, you look at areas that are the tremendous irritants like gasoline prices; those have obviously leveled out. Food prices are in the process of doing that. Shelter prices, meaning rents and home prices, still extremely elevated on balance. So it's not just the year-over-year change; it's the absolute level. And we may or may not see prices go back to where they were before. I would not really expect that to happen, but rather it's really the year-over-year change that everybody's targeting, and that includes the Federal Reserve.
Bankrate Senior Economic Analyst Mark Hamrick, good to talk to you today. Appreciate the time.
Thank you.